Michael Dix, Head of Research at Barclays Wealth, joins us now live in the studio. So explain this forecast to me, Mike.
Well, I think people are freaking out because if you go into a double dip, the cost can be huge in terms of equity markets. I think in terms of the probabilities, from here, we've actually got a consumer that's doing okay. Not doing great, but 1.5% to 2% growth in the volume of consumption, with income growth ahead of that. And that being 2/3 of the economy, that should keep the economy on what I call a growth recession trajectory. In other words, growing and not growing fast enough for the unemployment rate to fall, but avoiding, the double dip, the actual declines in GDP that we obviously saw a year or two back. So the main story is consumer, and then the second part of it is firms are doing very well in terms of profits. They really restored their balance sheets to shape, and we're beginning to see investment, not in things like the residential sector or structures, but if you like, smaller items, capital expenditure, things like software. That's coming back, and I think that will continue because the corporate sector is doing very nicely.
And your overall investment strategy right now encompasses equities with high-quality bonds. Can you explain a little bit more about that to me?
Yeah, I think of it in terms of an overall portfolio, we're trying to do what I call a barbell, where we're saying there is a risk of that double dip, and in that scenario, things are awful for the equity market. So have some core government bond markets, some coverage there. And then, if you like, in the more likely scenario, where the world comes back into that okay sort of growth story, in other words, not a double dip, moderate growth, equities can do quite nicely. So we're overweight government bonds, overweight equities, and then very, very short on things like cash and some elements of, if you like, alternatives.
It's curious because the Federal Reserve recently downgraded its outlook for the US economy. We've had a string of weak economic data, consumer spending not picking up fast enough. With non-farm payrolls, the focus is going to be on private sector jobs. That's not picking up fast enough either. And yet you're overweight in the US.
It's interesting. We put this strategy on actually at the beginning of July. Since that time, both bonds and equities have actually gone up about 4.5%, just over. So actually both have performed, and what we were really expecting is to get one to perform and the other not. And in net terms, one would do okay and the other would, in a sense, broadly offset it. So far, it's almost been too good to be true. And I think looking ahead, most people are focused on, might it be that really bad scenario and the equity's falling? But actually, you don't just want to bet on the punt. In a sense, you want to bet on the fact that we're going to be flip-flopping between those two scenarios. And we suspect...
So you need to diversify, you need to spread the wealth around a little bit. You wouldn't focus on one or the other right now?
No, because it's too sharp a call. It's like catching the falling knife. It isn't the time to try and get that right. There may come a time where it becomes clearer that pressures are building for one or the other scenario, but at the moment, keeping your options open and, as you say, keeping diversified is very important.
But looking ahead, do you think that we will continue to see solid returns from both stocks and long-term government bonds?
Well, we suspect in the very short term the gloom and doom may have been overdone. So if you were thinking about just this next month or so, I suspect we're going to get evidence that the US economy isn't going from 1.5% down to zero or negative. It'll probably bounce back and the third quarter be a bit better than the second. If that happens, there's a fair chance that equities do a little bit better. But as I said, we don't want to punt on that. That doesn't seem to be the opportunity out there.
How much confidence do you have in the ability of the authorities to prevent deflation?
Quite a lot, in the sense that, if it's the other way around and you're trying to prevent an inflation and preventing your currency collapsing, it's very, very tough. If it's a question of how much do you want the printing presses to run because you want to slosh money into an economy, QE2, and if you like, try and prevent prices from falling, a lot can be done. So the Japanese failed, but they failed because they didn't show enough, if you like, desire to achieve their aims. I think Bernanke's Fed does want to go there, and it can be successful.
The picture is reasonably positive. I mean, you think you're talking about a slowdown as opposed to a full-blown double dip. You don't think government debt on both sides of the Atlantic poses a significant risk to the picture that you're talking about?
Well, it may in the longer term, but more represent an inflation risk. If you were saying 5 years out, if you do slosh a lot more money and you double that balance sheet again, say, in order to avoid the horrible scenario now, ultimately you may create some, if you like, second-order problems that are quite significant. But I think that isn't on people's minds now, and it won't be on people's minds, I don't think, for several years. It's avoiding the double dip that matters now.
A cocktail of stocks and bonds. Michael Dix, Head of Research at Barclays Wealth. Thanks so much for your time. Appreciate it.